What if I told you that most investors are making investing far more complicated than it needs to be? You can build serious wealth with just 3 ETFs. 3, not 30 stocks, just 3 ETFs. And that's important because most people aren't professional investors. They don't have time to research hundreds of companies or figure out which stock is going to win next. They have careers, families, businesses, lives. And if you're trying to pick the next Amazon or Nvidia, you're already making investing harder than it needs to be. Because building wealth isn't about finding the next winning stock. It's about owning great businesses, staying invested, and letting time do the heavy lifting. So let's take the guesswork out of it. If I were starting over today, here's exactly how I'd build that portfolio. I'll show you the actual ETFs I would use, the role each one plays, and how I would adjust the portfolio, whether you're 25, 45, or already approaching retirement. You'll see the exact allocations I would use at different stages of life and how one optional position can be used to customize the portfolio for your own goals and risk tolerance. Ready? Let's get into it. One of the biggest myths in investing is that more complexity leads to better results. It doesn't. In fact, many investors spend years building portfolios that are far more complicated than they need to be. 10 ETFs, 20 ETFs, individual stocks, sector funds, international funds, dividend funds, growth funds, and before long, they've created a portfolio so complicated they can barely explain what's in it. But here's the problem. Complexity doesn't guarantee better returns, and it certainly doesn't guarantee better decisions. Because every additional investment creates another opportunity to second-guess yourself, another position to monitor, another headline to react to, another reason to panic when markets get volatile. The most successful investors understand something different. Investing isn't about owning more, it's about owning the right things. The goal isn't to build the most complicated portfolio, the goal is to build the most effective one. A portfolio that gives you broad diversification, long-term growth, reliable income, and enough flexibility to adapt as your life changes. Because whether you're 25 or 65, the fundamentals of building wealth remain surprisingly simple. Own great businesses, stay invested, keep costs low, and give compounding time to work. That's exactly the philosophy behind the portfolio I'm about to show you. A portfolio built around 3 core ETFs and 1 optional position that can be customized based on your goals, age, and risk tolerance. So let's build it. First up, what does the portfolio actually look like? At its core, it's built around 3 ETFs. Each one has a specific job. And together, they create a portfolio designed to grow with you through every stage of life. The first ETF is your foundation. This is the bedrock of the portfolio. The piece designed to give you broad exposure to the American economy and some of the world's most successful companies. The second ETF is your income and stability engine. Its job is to generate cash flow, provide resilience during market volatility, and help smooth out the ride when growth stocks inevitably hit turbulence. And the third ETF is your Growth Accelerator. This is where we lean into innovation, technology, and the companies driving future economic growth. Together, these 3 ETFs create a simple but powerful framework, a foundation for stability, an income engine for resilience, and a growth engine for long-term wealth creation. But here's where things get interesting. Most investors stop there. I don't. Because investing isn't one size fits all. A 25-year-old building wealth has very different needs than someone preparing for retirement, which is why I include what I call the flex position. This isn't a required 4th ETF, It's an optional position that allows you to customize the portfolio based on your goals, stage of life, and risk tolerance. For some investors, that might be international exposure. For others, it might be individual stocks. While some of you may prefer cash, bonds, or even a small allocation to alternative assets like crypto, commodities, or REITs. The core three stay remarkably consistent. The flex position adapts as your life changes. That's what makes this framework so powerful. Simple enough for a beginner, flexible enough for an experienced investor, and designed to evolve with you over decades, not months. Now, a portfolio is only as strong as the investments inside it. So let's take a closer look at each ETF, the role it plays, and why it earned a place in this portfolio. But before we do, if you're finding this helpful so far, do me a quick favor and hit the like button. It helps the channel tremendously and tells YouTube to show this video to more people who are trying to learn how to invest and build wealth. All right, let's reveal ETF number 1 and break down why it's the foundation of this entire portfolio. Every great building starts with a strong foundation, and investing is no different. If this portfolio were a house, the foundation ETF would be the concrete slab everything else sits on. Its job isn't to be the star of the show. Its job is to provide broad exposure to the American economy and create a stable base for long-term wealth creation. For me, that ETF is VOO. VOO is Vanguard's S&P 500 ETF. When you buy a single share of VOO, you're not buying one company. You're buying ownership in approximately 500 of the largest publicly traded companies in the United States. Companies like Apple, Microsoft, Amazon, Nvidia, JP Morgan Chase, Visa, Costco, and hundreds more. In other words, you're not betting on a single company. You're betting on American business. Over time, companies come and go. Leaders rise and fall. But the index adapts. As weaker companies drop out, stronger companies take their place, which means you're constantly invested in many of the largest and most successful businesses in the country. And that's really the beauty of index investing. You're not buying ticker symbols, you're buying ownership. Now, some investors prefer VTI, which owns virtually the entire U.S. stock market, and that's a perfectly reasonable choice. But for me, VOO strikes the right balance. It gives me exposure to America's largest, most established companies while remaining incredibly simple, low cost, and easy to understand. That's why VOO serves as the foundation of this portfolio. It provides diversification, long-term growth, and exposure to some of the most profitable businesses ever created. But a foundation alone isn't enough. We also need something that can generate income, provide resilience during market volatility, and help smooth out the ride. That's where ETF number 2 comes in. If VOO is the foundation of the portfolio, then ETF number 2 is the shock absorber. Because investing sounds easy when the market is going up. It's much harder when your portfolio drops 20, 30, or even 40%. That's when investors panic, when they abandon their strategy, and that's when long-term wealth-building plans fall apart. That's why the second ETF in my portfolio is SCHD. Now, SCHD is often called a dividend ETF, and while that's true, I think that description misses the bigger picture. SCHD isn't just about dividends, it's about quality cash flow, and it's about owning businesses that have already proven they know how to generate profits through good markets and bad ones. Companies like Coca-Cola, United Health, Verizon, Texas Instruments, businesses operating in completely different industries, but all sharing two important traits: consistent profitability and a long history of returning cash to shareholders. While growth ETFs focus on tomorrow's innovators, SCHD focuses on companies generating substantial profits today. companies that pay shareholders to own them. And that brings me to one of the biggest mindset shifts investors need to make. Wealth isn't just about what you own, it's also about what your assets pay you. Think about it this way. Most people spend their entire lives working for money. But truly, wealthy people eventually reach a point where their money starts working for them. That's where dividends come in. When companies inside SCHD generate profits, a portion of those profits is distributed to shareholders in the form of dividend payments. And if you're reinvesting those dividends, you're using those payments to buy even more shares, which then generate even more dividends, which buy even more shares. It's one of the simplest examples of compounding in action. Now, traditionally, many investors use bonds as the stability portion of their portfolio. And for some investors, particularly those in retirement, bonds may still have a role to play. But for investors who are still building wealth, I prefer SCHD because it gives me the opportunity to generate income while still participating in long-term market growth. In other words, I don't have to choose between growth and cash flow. I can have both. That's why SCHD serves as the income and stability engine of this portfolio. VOO helps me own America. SCHD helps me get paid while I do it. So far, we've built a strong foundation. VOO gives us broad exposure to the American economy. SCHD provides income, quality, and resilience. But if we're still in wealth building mode, we need one more thing: growth. That's where ETF number 3 comes in. For me, that ETF is SCHG. SCHG is a growth-focused ETF designed to give investors greater exposure to companies that are growing faster than the broader market. Think companies leading innovation, technology, artificial intelligence, healthcare breakthroughs, digital infrastructure, and the industries helping shape the future economy. Now, this isn't about chasing hype. It's not about trying to predict the next big thing. And it's certainly not about gambling on a handful of speculative stocks. It's about recognizing a simple reality. Throughout history, innovation has been one of the most powerful drivers of wealth creation. The companies that solve problems, increase productivity, and change the way we live and work often create tremendous value over time. SCHG gives us additional exposure to those businesses, and that's why I call it the Growth Accelerator. VOO already gives us growth, but SCHG allows us to lean a little harder into the areas of the market that have historically driven much of that growth. Think of it this way. VOO is the engine. SCHD helps smooth out the ride, while SCHG presses a little harder on the accelerator. Not because we're trying to get rich overnight, but because we're still building wealth. And when you have decades ahead of you, growth matters a lot. Now, could you use a different growth ETF? Absolutely. Some investors prefer QQQM, others prefer VUG. All three can serve a similar role inside the portfolio. The specific ETF matters less than the purpose it serves. And that purpose is simple: to increase your exposure to long-term growth. So now we have our 3 core positions: a foundation, an income and stability engine, and a growth accelerator. But investing isn't one size fits all. A great portfolio isn't just about what you own. It's also about how you put the pieces together. Because a portfolio designed for a 25-year-old should look very different from one designed for someone approaching retirement. So let's talk about allocation. Now that we understand the 3 core ETFs, the next question is, how much of each should you own? And the answer depends on one thing: time. More specifically, how much time you have before you'll need this money. Because a 25-year-old investing for retirement has very different needs than someone planning to retire in 5 years. That's why I don't believe in one-size-fits-all portfolios. The core three remain remarkably consistent, but the percentages change as your life changes. And before we talk about those percentages, there's one final piece of the framework you need to understand: the flex position. Most portfolios fail because investors keep adding things: more ETFs, more funds, more complexity. The flex position isn't an excuse to do that. It's a way to customize the portfolio without breaking it. Here are the three rules. Rule number one: the core three stay intact: VOO, SCHD, and SCHG. Rule number two: the flex position solves a specific need, not a random idea, not a hot stock tip, not something you saw on social media. A specific need: international diversification, additional income, capital preservation, or a small allocation to a higher risk opportunity. Rule number three: the flex position stays relatively small. Because the goal isn't to reinvent the portfolio, it's to personalize it. The core three build wealth. The flex position fine-tunes the strategy. Now let's look at how I would allocate this portfolio at different stages of life. But before we jump into those allocations, if you're finding this video helpful so far, I'd really appreciate your support. Hit the like button, subscribe if you haven't already, and if you think this video deserves it, tap hype as well. Every one of these helps YouTube share this video with more people who are trying to learn how to invest and build wealth. If your 20s and 30s were about building momentum, your 40s and 50s are about acceleration. For many people, these are their highest earning years. Careers have advanced, businesses have matured, income has increased, and hopefully, years of consistent investing have started to compound. But this is also the stage where many investors begin to panic. They're running retirement calculators, looking at college expenses, thinking about aging parents, wondering if they've saved enough, and suddenly they start questioning everything. Should I be more aggressive or conservative? Or should I move everything into cash? The answer is usually none of the above. Because while retirement may be getting closer, you still have something incredibly valuable on your side: time. Many investors in this stage still have 15, 20, or even 25 years before retirement. That's plenty of time for great businesses to continue growing and compounding, which is why my allocation for this stage looks like this: 35% VOO, 30% SCHD, 35% SCHG. Notice what's changed. Growth is still important, very important. But we're beginning to place a greater emphasis on income and stability. SCHD moves from 20 to 30%. Not because we're abandoning growth, but because we're starting to think differently about risk. At this stage, the goal isn't simply to accumulate more assets, it's to build a portfolio that can continue growing while becoming more resilient over time. The foundation remains strong, the growth accelerator remains important, but the income and stability engine begins to play a larger role. Think of it this way: in your 20s and 30s, you can afford to be a little more aggressive because time can help you recover from mistakes. In your 40s and 50s, you're still building wealth. But now you're also protecting the progress you've already made. That's an important distinction, because successful investing isn't about taking the most risk. It's about taking the right amount of risk for your stage of life. And if you choose to use a flex position during this stage, I generally prefer options that improve diversification or strengthen long-term planning. For some investors, that may mean adding international exposure through a fund like VXUS. For others, it may mean increasing contributions to tax-advantaged accounts or building a dedicated healthcare strategy through an HSA. The specific choice matters less than the purpose behind it. Remember, the core three build wealth. The flex position fine-tunes the strategy. And sometimes the smartest adjustment isn't adding another investment. It's making better use of the accounts available to you. One account, in particular, deserves serious attention during this stage of life. The Health Savings Account, or HSA. By your 40s and 50s, healthcare expenses are no longer a distant concern. Many investors are not only thinking about their own healthcare needs, but also those of their spouses, children, and aging parents. At the same time, these are often your highest earning years, which means they can also be your highest tax-paying years. That's what makes the HSA so powerful. If you're eligible, it offers a rare triple tax advantage, tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. No other account offers that combination. And unlike many people who use an HSA as a short-term spending account, I prefer viewing it as a long-term wealth-building tool. Invest it, let it grow, and give compounding time to work. Because one of the biggest threats to retirement wealth isn't market volatility, it's healthcare costs. The more prepared you are today, the more options you'll have tomorrow. But healthcare isn't the only risk that can derail a long-term financial plan. Life has a way of surprising all of us. Which brings me to one more thing I want investors in this age group to pay close attention to. Your emergency fund. In your 20s and 30s, an emergency fund helps protect you. In your 40s and 50s, it helps protect everything you've built. At this stage of life, financial responsibilities tend to multiply. Children, college expenses, mortgages, businesses, aging parents, and often higher monthly expenses across the board. That's why I generally recommend having at least 6 months of living expenses set aside in a high-yield savings account, money market fund, or short-term CD. Not invested, not chasing returns, just safe, accessible, and available when life happens. Because one unexpected expense shouldn't force you to interrupt a long-term investment strategy. Your portfolio's job is to build wealth. Your emergency fund's job is to protect it.